All right, so something interesting is going on over at Shoe Carnival. They just dropped some pretty confusing numbers, and oh yeah, their CEO is suddenly out the door. So in this explainer, we're going to put on our detective hats, piece together the clues, and figure out what is really going on.
Okay, let's just get right into the numbers that have everyone talking. First, fourth quarter revenue, it missed expectations. Not great. Then, their earnings forecast for the year ahead, down a whopping 21%. And, no surprise, the stock immediately took a dive. Look, this isn't just a bad quarter, it's a signal that something much bigger is happening under the surface.
But honestly, those numbers are only half the story. The real bombshell dropped right before this report came out. The company's president and CEO, Mark Worden, was just gone. A leadership change that big, right before you release some tough numbers, that's a huge red flag for anyone watching.
So yeah, this all brings us to the big question, right? What on earth is going on at Shoe Carnival? Let's dig in and break it all down.
Our investigation has to start at the very top, with that sudden shakeup right at headquarters. So to steady the ship, the board brought back a very familiar face, Cliff Sifford. This is a guy who was CEO for nearly a decade, from 2012 to 2021. This move, it screams that they're trying to get an experienced hand, someone who knows the company inside and out, back on the wheel.
So what was actually happening that would lead to such a dramatic change in the first place? Well, it all circles back to this one big, really ambitious plan that was at the absolute heart of the company's strategy.
The key to understanding this whole situation is one single strategy, and it's called rebannering. This was the big idea. Take their classic Shoe Carnival stores and literally convert them one by one into the more upscale Shoe Station format that they had acquired.
And you can see here, these are two totally different playbooks. On one side, you've got Shoe Carnival. That's the company's workhorse, right? It serves that more urban, value-focused shopper. On the other side, you have Shoe Station. It's got the more premium brands, and this was supposed to be the engine for all their future growth.
And listen, they didn't just dip their toes in the water on this one. They went all in. They converted a massive 101 stores in the last fiscal year alone. This wasn't some small pilot program. This was a full steam ahead, bet the farm kind of move.
So, they went all in on this plan. What happened next? Well, it's a classic story of when a big, bold strategy starts to stumble.
The new interim CEO, Cliff Sifford, he did not mince words. He got right to the heart of it with this quote. He's basically saying they put the fancy, premium Shoe Station concept into the old Shoe Carnival locations, and the original customers just weren't having it. It was a classic product-market mismatch. They overestimated their ability to change their core customer shopping habits overnight. And wow, the data here is just stark. This chart tells the whole story. The Shoe Station banner, it saw some modest growth, sure, but the core Shoe Carnival stores, a pretty significant sales decline. That 10.4 percentage point gap, that is the entire problem in a single picture.
So what's the result? They are hitting the brakes, and they're hitting them hard. The program is getting slowed way, way down, from 101 conversions last year to just about 21 planned for this year. That is a massive strategic pivot.
Okay, so a struggling strategy explains why they're slowing down, but what about that huge drop in the profit forecast we talked about? Well, that brings us to what's happening with their profits, the great margin squeeze. Now, this next part, it gets a little into the weeds of finance, but it's actually a pretty simple story about timing. I want you to think of it like this. Last year, the company got this huge temporary discount that made their profits look absolutely amazing. But now, that discount is gone, and reality is setting back in.
Let's just walk through it step by step. So first, back in 2025, Shoe Carnival really smartly raised its prices before the higher costs from tariffs actually hit their inventory. And that created this sweet spot, right? A temporary kind of artificial boost to their profit margins. But now, here in 2026, those higher tariff-related costs have finally arrived. So that 2025 benefit, it vanishes. And that leads to a sharp kind of painful drop when you compare the 2 years.
And this slide puts a hard number on it. They expect a drop of 260 basis points in their gross profit margin this year. Now, for some context, 100 basis points is just 1 percentage point. So we are talking about a significant 2.6% drop. That is a huge hit, and it's driven almost entirely by that timing issue we just walked through.
So you've got a new leader. You've got a fresh look at the strategy. How do they plan to stabilize the ship? Well, it all comes down to a new, pretty straightforward 3-point plan.
Here are the new priorities, and it is a very back-to-basics kind of approach. First, cut down on inventory by up to $65 million. Second,
Only move forward with those 21 store conversions they are absolutely confident about. And third, tighten the belt and cut operating costs. It's a simple, direct, and really disciplined plan.
And this is really important to remember. Despite all this drama, the company's foundation is rock solid. They've been debt-free for 21 years straight and are sitting on over $130 million in cash. They absolutely have the financial strength to pull off this turnaround.
So after all that, what is the big takeaway here? Well, it signals a really fundamental shift in their strategy, which raises the question, what does the future actually look like now?
The new goal is not to turn every single store into a shoe station. No, instead, they're pivoting to a future where they operate two distinct banners, each with its own identity, serving its own specific customer. And listen to how definitive the new CEO is here. He's making it crystal clear they are not reversing course on the stores they've already converted. This really signals a commitment to making both Shoe Station and Shoe Carnival successful, but on their own terms. It is a dual brand strategy from here on out. And that brings us to our final question. Looking forward, the company learned a pretty tough lesson here. Their grand plan moved too far, too fast. Now the big pivot is all about meeting their different customers right where they are. The billion-dollar question now is whether this disciplined step back will ultimately prove to be the right step forward.